Hey there, welcome back to The Real Rant. And this is a show about how to develop assets, cash flow, and produce real returns in the world of commercial real estate. So, with that said, today we are really going to be focusing on that. I'm excited to share this morning. We got Daren Laureano with us, CEO and founder.
Thanks for having me.
So, we have a great subject today, and it's a conversation we have around the office called The Four Things, right? And that'll become a little bit more clear. But the four things are what you must know before acquisition. That's the key thing to really have a successful commercial real estate project. And in our world, successful real estate project typically means opportunistic type of returns. Okay, so four things. What is the number one thing we need to know to make commercial real estate projects work and work efficiently?
So again, going through the four things, and you have to know these before you acquire the asset. Like again, guessing at these, a year after you've done acquisition and hopefully accidentally being right, it really doesn't count as a strategy. That's not real. It happens a lot. You'd be surprised. But the four things are: what can I build? Where can I build it? How much of it can I build? And probably the most important, how long will it be before somebody lets me build it? You don't get to just go swing hammers anytime you want. You need a fact based schedule from sources and people and organizations that you know to be right consistently.
Right. And I think that's a big factor too. And something you've always tried to live by, something that we've implemented at Southern California Equity, is a vertical platform is going to give you better information, more timely information, and the kind of quality that you need to get the right answers. If you're asking the wrong questions and listening to the wrong responses, it's going to be really hard to
It
make this
is. And
work,
I
right?
think oftentimes people spend the majority of their time on the easiest one of those, not realizing that the other three are massive impediments to that first one. The first one is what can I build? That's actually the easiest one, and people spend most of their time focused on what, and they think they have the answer to that. But the challenge is that the where and the how much of it can you do has a massive impact on what you do. So if you're blowing those two middle ones, which is, where can I put it? Because there's about a million rules and regulations and things that have to do with where something can go. New construction easier than adaptive reuse than what we do, but adaptive reuse and repositioning, deep repositioning the way we do it's actually pretty obvious to us after many years. And then we'll get into the how long, I think, is the other one that is probably the biggest struggle and really the most important one, and the one you were alluding to, which is you're relying on outside sources to tell you the schedule. But what they do is they come up with an imaginary schedule based on their spreadsheet of financials. That's the wish list. And I often have people come to me and lay this out. And when I go to LPs, call me in, or when I'm advising in a fund and we're going over that and I'm providing oversight, the first thing I put my foot down on is schedule. Nothing you just said makes sense. At Southern California Equity, obviously, we have inside sources, in-house sources. We don't rely on outside sources, especially for schedule. That's probably the most important one. But that what you can do is the easiest.
So you said something there that I think is important too, in how long you talked about our strategy in adaptive reuse compared to ground up, which obviously we can do both. But the advantage to adaptive reuse is speed, right? We can get stuff done in a way more timely fashion. But I almost hate to do this, but I think I'm going to go there anyways. When we are in meetings, we talk about the
Yeah,
common GP. Obviously, we like to think of ourselves as the
yeah.
uncommon GP, but the common GP doesn't have the right answers to that one particular question, which is starting from a premise of, man, we're behind the eight
Yeah.
ball most.
Now the good news is the common GP is still producing pretty good returns. But yes, the fact-based schedule and being able to rely on inside sources rather than outside sources, they rely on a lot of outside sources who tend to be wrong. And ultimately what happens is you end up with what I call, the three pillars of fiduciary management, which are risk, liability, and delay. And a lot of those bad ideas from those outside sources ultimately rear their ugly head towards the end of the project and end up with either liability, lawsuits, delay. You're not in there, your tenant's not in there. You end up with your tenants basically coming back to you saying they're screaming in their lease. They're saying delay, 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 landlord delay. And ultimately, you guys end up with kind of a massive financial issue, and the attorneys are sorting it out. So yes, relying on outside sources is not good. It usually results late in the project is where those things come out, because ultimately the checks and balances in commercial real estate eventually show up. It doesn't do you any good unless you have a tremendous amount of experience. And a lot of what we call the common GPs rely on their inside, very young spreadsheet pilots from good finance schools. I know this because my son's in finance school at TCU, so we're aware of that. You and I both went to the University of Southern California here in SoCal, and you see them kind of run the playbook, guys, but they actually don't know where to understand who's actually giving them the real schedule and how to create a real schedule that ultimately gets you from acquisition through development, through certificate of occupancy, through a tenant, finding a tenant. This is critical, finding a high credit tenant currently in the market, not 1-2 years from now. And we see a lot of people come to us, a lot of GPs that I've talked to, and I know from my many years and decades doing this, they might be sitting on an asset for a year or two before they even have a development plan right now. Coming full circle, like adaptive reuse and deep repositioning, where we're really invasive into these structures and we really create Class A out of basically distressed properties and industrial properties and the types of things that we're really, really good at. They result in, very simply, bigger buildings, faster buildings, less expensive buildings, and sustainable buildings. So those are the things, and those are the types of assets we're
Yep.
looking to do: faster, bigger, less expensive, and sustainable.
You touched on something that when I'm talking to LPs, I think is important, especially in this cycle. In previous cycles, when money was cheap, there was nothing to it. Where we are today is financial engineering isn't really going to get you there in this new
No.
cycle. It's real estate skills and operational excellence are really the differentiator. You'll be able to come up with some cash flow, but the financial engineering era has subsided, and now you actually need to know how to do stuff. You need to know how to do real estate, and that's where I'm excited about. So that's the first thing. Let's talk about the
Yeah,
second.
we'll jump into where you can do it in a second. But I just want to point out that, again, the GPs, they do make a lot of good decisions. I think their returns can be a lot better than they are most of the time. But LPs are going to resonate with what we just said. I talk to LPs all the time. I get called in for
Yeah.
limited partner advisory board sessions. I get oversights, what I've done for many years. I have an excellent track record at it. Predictably, accurately, calling these things over a very long career. So yeah, no, I think the investors and the LPs, that when they see this, they'll really understand what I'm talking about: risk, liability, delay, and really what we call the four things, which are what, where, how much, and how long. So yeah, let's go to the next one. Let's go to where. Where can I build it?
Yeah. So, one of the things that at Southern Caliber Equity we specialize in is building stuff in the hardest jurisdictions maybe on planet Earth, at least that we're aware of. So, where obviously is important, and being able to navigate where is a thing too. So, why don't you talk a little
Yeah.
bit about,
Well,
where
we'll
you can
break these
build
things
stuff?
down in more detail another time, because you can go into a lot of depth in these and just kind of detail everybody to death. And
Yeah,
I
yeah.
really
Let's
don't think
keep it.
most people want to, get into those nuts and bolts unless it's a specific episode for that. So we'll get into that. But where? So this is the most, probably, I find it to be the most misunderstood of all of these. Because when you're looking at commercial real estate, and by the way, I find commercial real estate way easier than residential real estate. I've done, multifamily, I've done mixed use, commercial, residential, I've done 100% affordable, I've done density bonus affordable, I've done condominiums, I've done live work, I've done you name it. I actually find commercial, while most people want to go residential, I find commercial actually to be easier. But coming back to where,
Yeah.
really, when you look at this, there's really only one or two viable solutions, maybe an outside third. There's not 10 options. And I think that really gets misunderstood between the GPs and the developers in particular, where you come into this asset, you come into this acquisition, you're looking at this thing and you think, and you're talking to a various number of outside sources and you're convinced that there's 10 options. There's not 10 options. when you factor in all the um, conflicts that exist on any particular piece of residential or commercial property, the conflicts that exist in any given particular,
Yeah.
building, or the history of it, or if you're building new, the massive amount of overlays and jurisdictional regulatory issues. Factor in, the financials from the spreadsheet pilots that we just talked about, which are great. Obviously, financials is a big factor in this. You can't just go do whatever you want. But when you put in the what can I do, meaning, is this, for us, we just do a lot of entertainment production, media production, sound stages, innovation led economies, medical biotech. Those are the types of things our fund focuses on. But if you're looking to do almost any kind of commercial, obviously we've seen office just drop off the cliff, but it's not freestyle. You don't get to do whatever you want in any particular asset, zone, property, part of the city. Most people will say zone, it's zoned this. Or I hear this phrase, this is actually hilarious. I hear this phrase called it's zoned med spa, or it's zoned office, or it's not zoned office. That's not a thing. That's not real. That is an allowable use in a long list of uses in any given jurisdiction, in any place in the country, any place in the world, really. And you have to be very good at that. But that's the easy part of the what. The where is, setbacks, height limitations, density bonuses, and then you factor in all the other things from other outside sources that you need to be very mindful of. Allowable building area, the safety issues, the cost factors that go into all of those, implementing all of those different things in order to maximize your floor area. You can't just, freestyle in. These things are critical to know before acquisition.
Yeah.
Where exactly is it going to go, so that you can build that into your financial model prior to acquisition, so you're not losing time and you're effectively managing the LP's money over the duration of the life of the fund or the investment.
Yeah. And I'm just going to keep returning a little bit just to refresh that the key to profitability, the key to cash flow, and certainly opportunistic returns is speed. And all this is about getting from acquisition to occupancy as fast as possible. So that's where in a little bit. And again, we'll be able to take deeper dives on these kinds of things in other episodes. We can geek out all
Yeah.
day on how to actually, get a real estate building built, which is the key to making profits in real estate funds. So let's talk about the
Yeah.
third
So
thing.
how much of it can you build in any particular asset? It's
Very
pretty
important.
critical to, plug in the numbers into the spreadsheet and the valuations and the return on investment and the IRR projected over a number of years, whatever your fund is trying to do. Yes, but again, another massively misunderstood element within any given asset is that how much. Now, in ours, we're taking a lot of existing adaptive reuse, and if people know what adaptive reuse is, where we're taking an existing distressed asset, we're really going invasive, tearing it apart, turning it into a Class A entertainment production media facility. We can see a lot of them on our website if you go look. And that how much of it, because we're always looking to add value, right? We're going to be a value add. We're looking to do a 10, 20% increase, 25% increase in floor area ultimately, which makes our assets bigger. But even if you're doing ground up, there are so many factors in it. And I'll tell you the one that a lot of GPs walk into all the time, and their LPs don't really understand it very well, is the famous public hearing where you have to, go through some process and everybody wants to decide to use their brilliant real estate opinion on your development and decide for themselves how much you can build,
Mm,
and they just pull a number arbitrarily out of thin
mm.
air. Well, we think you should be this. And you're like, well, that has nothing to do with the reality, the jurisdiction, the asset, the property, our concept, our, financial strategy for this particular asset. It just has nothing to do with it. But everybody has an opinion on it. That probably goes into,
Mm.
and this is a whole other episode altogether, the sequence with which you make your requests and the sequence with which you put your investment strategy together is where most GPs, most
Yeah.
developers are probably making their biggest mistakes, is not see, and their outside sources just flat out don't know. And putting your requests in to move in the right order to simplify getting what I call the yes, yes answer out of any particular place, people, thing, bank, institution, or whatever else it is.
That's super important. And it's really just a success principle. Success has patterns and requires pattern recognition in whatever you're doing, whether you're an athlete, you're in business, relationships for sure. But pattern recognition is critical. And success isn't always just doing the right thing. Success has another component, and that's doing the right thing at the right time in the right
Yes.
order. That is predictable success. And that's where a 30-year track record, you seeing things from every angle, you know these patterns. You know that the right thing at the right time in the right order is going to deliver this result
Yeah.
every single time.
Yeah,
Make
no, that's
sense?
100% true. There's a whole bunch of rules for life safety principles and those types of things that all affect how much of this you can do. You can't just build as much as you
Yeah.
want, as high as you want, anywhere you want. And most of us in the industry that have been around a long time know those things. I'm not going to go into that here. If somebody wants an episode on that, maybe they can leave something in the comments and we'll do an episode
Yeah.
about those types of things. Stay high level with particular our fund model and what we see as kind of common
Yep.
mistakes. But the what can I do? They have no idea. They don't really have a solid strategy. They're vacillating between two different concepts. The where can they do it? Which part of the site? How it's going to fit in? This jigsaw piece of myriad of problems that exist both in practical and jurisdictional nonsense that you hear about, and then how much of it can you build? Those all it ends up being a
Hmm.
puzzle. And those three things, we'll get to the fact-based schedule in a second, but those three things end up being such a jigsaw puzzle. That's what I mean about narrowing down. You don't have 10 options. There aren't 10 options. There's two probably good ones and maybe an outside third possibly.
Yeah. So that's good insight for sure. And, all this boils back into getting tenants into buildings
Yeah.
as fast as possible, especially in your history and in our model is we're identifying tenants prior to construction and development for sure. But, there's these fact-based schedules that are important to get tenants into building, to get occupiers into buildings so they can, do what we've
Yeah,
committed to doing for
absolutely.
them.
So that how long is a big thing. What I call the fact-based schedule. Fact-based schedules are proven. You have evidence. They leave clues. They have paperwork that go with them. It's not just oh, the contractor thinks it's going to take this long to build it, or oh, the architect thinks he's going to get drawings out in this amount of time, or who knows what, whatever it is. It has to do with a number of factors that you can lay in there that are you can calculate. You can pull these things out. You can find the facts and the clues and the chapter and verse, and you can find those out. That's why I always say a fact-based schedule, because if you're good at this, you can extract in writing determinations and decisions from your own people, from the lenders, from again the contractors, and look at the holes. And if you know what you and by the way, this is what really is what to do with the fact-based schedule. This is hilarious. It's not laying it all out and looking at it and understanding what's there. It's actually knowing what's missing. That is the absolute. If you
Mm,
can't look at these things and realize, wait, what don't I have here? Where is the missing? How do I know this? Where is this gap at in the massive pile of documentation that you're going to get laid onto you? Um, you're not really going to know. I have a good example of an asset that we did for some investors, and it was interesting. It was an acquisition from Fundrise, and they spent 2 years in not answering any of the four questions. In fact, to sell it to
ouch.
our investors, they were selling it and marketing it as office. And they're like, "Oh yeah, it's office," and it looked clean. It was kind of adaptive reuse. It looked clean, and it said office, and they had the square footage on there. None of that was real. The square footage wasn't real. The office wasn't real. The jurisdiction hadn't signed off on any of that. They had tried to add a second story to it for 2 years. They had two different attempts from multiple different teams. None of them could do it. They were overlooking some super obvious things. I'm not going to go into all those details for it, but ultimately our investors took it over. We drove the price down because those are conflicts, right? They couldn't prove with the CFO what they actually were marketing and trying to sell. Therefore, they were going to have to disclose this group that they had no office, because we had written them a pretty detailed, intensive letter about, hey, none of this is real. So it's better to deal with our group. And
Mm.
ultimately, those conflicts actually drove the market price down quite a bit, where ultimately we were able to add floor area and redevelop it. It's actually just finishing now, so maybe we'll get that up on the website when it's done.
Yeah. Well, there's definitely a Deal Doctor
Yeah.
episode there for sure. And, so that's a good overview of the four things.
What can I
Again, what are the
build?
four
Where can
things?
I build it? How much of it can I build? And how long will it take before somebody lets me build it? It's not, you don't get to decide how long. Somebody else is deciding that. And that's a critical factor in the whole deal.
Yeah. Before acquisition is
Yeah.
another key component to that. So we've got a lot of things. And so we got three pillars we can talk about. We got four
Yeah, we're
things. We
gonna
got to
come up
come
with
up
a
with a
five.
five.
I
I don't
have
know
the
if we
four
got
walls and a
five yet,
ceiling.
but
Maybe we'll, come back to that and do another episode with that at one point. It's actually pretty good. It overlaps some of these other
yeah,
concepts,
very
but
good.
yeah, we do have to develop that five things.
Yeah, very good. So I think that was a lot of value. Hopefully, our viewers are going to find value in that. That's our objective in the Real Rant, is to give you practical things that'll help you be more successful as you undertake commercial real estate investing. And there's a lot to learn from the construction side on this thing, to actually getting stuff built. We want to talk about that because one of the things that we do at Southern California Equity is we believe when somebody's writing us a big check, that they expect a team that is thinking 24/7 about real estate solutions. And I think that's what all LPs deserve. That's what they want. And, that's our framework. We are operating all day, every day
Yeah, I
with
think.
solutions. So hopefully that makes some
Yeah, I just
sense.
think that it's
Anything you
interesting.
want to
You
add?
hear this a lot. Guy, and when people tell you this a lot, but it doesn't even feel like work anymore. To be honest with you, it's actually fun. So I think that's why it's cool to get on here and talk and chat with people. So if some people have questions or an episode or something they want us to do, they should leave a comment so that we know what that is and we can break it down for them more. But yeah, ultimately you kind of get there.
Yeah, we'll do some live stuff too down
Yeah,
the
just
road,
over a
call
life
it
and over that career,
the
you realize
mailbag
that
or
this isn't
something
really
like
work
that.
anymore. It's kind of entertaining.
Very good. Well, I think that's a good time to break. I think there's value here for sure. And we will see you on the
All right,
next
great
episode
to
of The
see
Real
everybody.
Rant.
Bye, too.